An LLC is a type of business entity. Mainly, your business entity type determines how you're taxed on your earnings, your personal liability for company debt and lawsuits, and which legal paperwork you need to file with your state and with the IRS. Business entities exist because there's a wide variety of businesses in the United States, and they come in all different sizes and structures. It wouldn't make sense for a small mom and pop restaurant to be taxed the same way that a big corporation like Coca-Cola is. To understand what an LLC is, you first need to understand what a sole proprietorship is. Sole proprietorships are not taxed separately from your personal taxes. When you file your annual tax return, you'll report all your business income, expenses, and deductions all on the same tax filing as your personal finances. The same goes for liabilities. When you form a sole proprietorship, your business assets and your personal assets are one and the same. If you choose not to register a business entity, then you're automatically considered a sole proprietor by the IRS. When you form an LLC, your personal assets won't be a risk if your business faces bankruptcy or lawsuits. An LLC protects you from personal liability. The owner of an LLC is called a member. If you're the only LLC member, then your business is considered a single-member LLC. LLCs are similar to sole proprietorships in that profits and losses are easily passed on to your personal income, and you don't have to pay corporate taxes. LLC members are still considered self-employed, so you still have to pay your own self-employment taxes toward Medicare and Social Security. An LLC only protects you from personal liability. Your vehicle, your home, and your savings accounts will be safe and cannot be repossessed during bankruptcies or lawsuits. But as the business owner, you'll still be responsible for paying your share of the business debt. Your business debt will not vanish into thin air. When it comes to taxes, sole proprietorships and LLCs have one big thing in common. The IRS considers them pass-through entities. Pass-through refers to how the IRS treats your business finances and your personal finances as the same thing. In a sole proprietorship, there's no difference between your personal income and your business income. In an LLC, there's no difference between your personal income and your share of the company's profits. Other business entities require that you file separate taxes for both your business and your personal finances, but under a sole proprietorship or LLC, you'll only have to file a single return. Under a sole proprietorship, all business profits and losses are reported on your personal tax return. You'll report these on Schedule C, which you'll submit to the IRS attached to your Form 1040. All your business income is taxable, even the money that you've set aside into a business savings account or investment fund. As a sole proprietor, you're required to pay self-employment taxes. These are basically the equivalent of the Social Security and Medicare taxes that traditional employers and workers pay. When you work for an employer, the worker pays for half their portion and the employer matches it. Under a sole proprietorship, you're going to pay both the employer's and the worker's portions via the self-employment tax. Benefits of sole proprietorship include easy tax filing, lowest tax rate of all business entities, and no corporate tax. They have great tax deductions. For example, one of the best tax advantages of the sole proprietorship is that you can deduct health insurance for yourself, your spouse, and your dependents, and you can claim this deduction even if you're not itemizing on your return. For tax purposes, the IRS treats LLCs as either a sole proprietor or a partnership, depending on whether it's a single-member LLC or a multi-member LLC. Single-member LLCs are treated like sole proprietorships. Multi-member LLCs are treated as partnerships. If you own a single-member LLC, you'll file your taxes just like a sole proprietor. You'll report your profits and losses on Schedule C and submit it to the IRS with your Form 1040. Just like with the sole proprietorship, you don't have to file a separate business tax return. LLCs may be more difficult to file than sole proprietorships because they might be a little more costly. If you're a member of a multi-member LLC, it can be difficult to estimate how much in taxes you'll have to pay on your share of the business, although a tax professional will help you. When you form a sole proprietorship, your business assets are considered your personal assets. That makes taxes a whole lot easier, but unfortunately, it also means that you can be held personally liable for any debts and obligations of your business. If your business goes bankrupt, the courts may seize your personal assets in order to settle your company's debts. Your personal assets may also be at risk if you're forced to pay damages in a lawsuit that you're unable to afford. You'll also be held liable for the actions of your employees. If you're sued for something that one of your employees does, it's your personal assets that may be at risk in a lawsuit, not your employees. LLC members have significantly more protection when it comes to bankruptcy and lawsuits. Under an LLC, your personal assets will be protected and cannot be seized by the courts. Only LLC assets can be sold to pay off debts. In the state of Texas, all LLCs are required to file the Texas franchise tax return. LLC earnings over $1.2 million in the state of Texas may be assessed the Texas franchise tax. Even if your earnings are less than $1.2 million, you are still required to file the Texas franchise no tax due report. Failing to file the Texas franchise return, whether you owe tax or not, as an LLC, will result in a monetary penalty.